Imagine discovering an AI stock that has already exploded higher in 2026, but whose biggest opportunity may still be ahead. It isn't Nvidia, it isn't AMD, and it isn't Broadcom. It's Marvell Technology, ticker MRVL. Marvell has suddenly become one of the most interesting companies in the AI infrastructure race. And now, Google has just made the story even more interesting. So the big question is simple. Is Marvell stock still worth buying in 2026? Or has the AI excitement already pushed MRVL too far? Let's find out. Marvell isn't primarily known for making the headline-grabbing GPUs that power artificial intelligence. Instead, Marvell focuses on something equally important: the infrastructure that allows AI systems to communicate, process information, and move enormous amounts of data. The company develops custom silicon, networking products, optical technology, and other semiconductor solutions designed for massive data centers. And that makes Marvell a very interesting way to invest in the infrastructure behind AI. Marvell itself says hyperscalers are undertaking one of the largest infrastructure build-outs in history, and that its technology is designed to support everything from custom compute to data center connectivity. And investors are already seeing the impact. In its fiscal first quarter of 2027, Marvell reported record revenue of about $2.42 billion. That was up roughly 28% year-over-year. Even more importantly, data center revenue reached approximately $1.83 billion, representing about 76% of total revenue. That's a massive transformation. Marvell is increasingly becoming an AI and data center company. But here's where the story gets much more interesting. Google. On August 19, Marvell announced an expanded agreement with Google to help develop custom AI chips. And this isn't just another ordinary customer relationship. Google received a warrant giving it the right to purchase up to approximately 59 million Marvell shares at about $206.58 per share. If fully exercised, the shares could be worth around $12.2 billion. More importantly, the agreement could potentially generate as much as $120 billion in revenue for Marvell through fiscal 2033, depending on performance milestones. Now, that number needs to be understood correctly. It does not mean Marvell has suddenly received $120 billion in guaranteed revenue. It represents a potential opportunity tied to the agreement and future performance. But it shows just how significant the relationship could become. And that's why investors are paying attention. Google has historically relied heavily on Broadcom for its custom AI chips. Now Marvell is becoming another important part of Google's custom chip strategy. That doesn't necessarily mean Marvell will replace Broadcom. It means the custom AI chip market is becoming bigger and more competitive. And that could be very good news for Marvell. Why? Because hyperscalers like Google, Amazon, and Microsoft are spending enormous amounts of money building their own AI infrastructure. And they don't necessarily want to depend entirely on one type of processor or one supplier. Custom silicon gives these companies more control over performance, cost, and energy efficiency. Marvell is positioned to benefit from that trend. And this is one of the biggest reasons I find MRVL interesting. The AI infrastructure market isn't just about GPUs anymore. It's expanding into custom accelerators, networking, optical connectivity, memory infrastructure, and specialized silicon. Marvell operates across several of those areas. In fact, Marvell's data center business has become the company's dominant revenue driver. That means the company's future is increasingly connected to one of the biggest technology spending cycles in the world: artificial intelligence. But now comes the uncomfortable part. Marvell stock has already experienced an enormous rally. That changes the investment equation. A great company doesn't automatically mean a great stock at any price. When expectations become extremely high, investors need the business to keep delivering exceptional results. And that's where MRVL becomes risky. The market is no longer asking whether Marvell can grow. Investors are asking how fast it can grow. They're asking whether AI demand can remain strong. They're asking whether Google and other hyperscalers will continue increasing custom chip spending. And they're asking whether Marvell can turn that demand into sustainable profits. That's a much higher bar. And there's another issue: competition. Marvell isn't operating in an empty market. Broadcom is a major competitor in custom AI silicon. Other semiconductor companies are also developing networking, optical and custom compute solutions. And hyperscalers themselves have enormous engineering resources. So Marvell needs to keep proving that its technology provides enough value for customers to continue choosing it. Then there's valuation. After such a powerful stock rally, even excellent earnings can sometimes produce a disappointing stock reaction. Why? Because the market may already expect excellent earnings. If Marvell reports strong numbers but gives weaker than expected guidance, the stock could fall. And that is especially important right now because Marvell is scheduled to report its fiscal second quarter 2027 results on August 27th. Investors will be watching much more than just revenue. They'll want to hear about AI-related bookings, custom chip demand, data center growth, margins, future guidance, and, perhaps most importantly, whether the Google agreement changes Marvell's long-term growth outlook. That earnings report could become a major test for the stock. So let's look at the bullish case. Imagine AI spending continues accelerating. Google expands its custom chip programs. Amazon and other hyperscalers increase their investments. Marvell continues gaining business in custom silicon and data center connectivity. Its revenue grows rapidly. Margins improve. And the company becomes one of the most important suppliers behind the AI infrastructure boom. In that scenario, today's valuation could eventually look much more reasonable. But there is also a bearish scenario. AI infrastructure spending could eventually slow. Hyperscalers could reduce capital expenditures. Competition could intensify. Custom chip programs could take longer than expected to scale. And Marvell's stock could experience a major valuation reset. Remember, AI infrastructure is a huge opportunity, but semiconductor stocks are still cyclical. Strong demand can create explosive growth, but expectations can also change extremely quickly. So what should investors watch? I would focus on 5 things. First, Marvell's data center revenue. Second, AI-related bookings and custom chip demand. Third, the company's revenue guidance. Fourth, gross and operating margins. And fifth, updates about major customers, especially Google and other hyperscalers. Those indicators could tell us whether Marvell's AI story is actually getting stronger or whether investors are simply getting ahead of themselves. So, is Marvell stock still worth buying in 2026? My answer is cautiously bullish. I think Marvell has one of the more interesting AI infrastructure stories in the market. The company is positioned behind the scenes of the AI revolution. Its data center business is already generating substantial revenue. AI-related demand is driving growth, and the new Google relationship could potentially become a major long-term catalyst. But I wouldn't call MRVL a low-risk AI stock. The biggest problem isn't the technology. It's expectations. After such a powerful rally, investors need to be much more selective. If Marvell continues delivering strong AI growth and successfully converts major custom chip opportunities into long-term revenue, the stock could have room to grow further. But if growth slows or expectations become unrealistic, the downside could also be significant. And that's why the upcoming earnings report matters so much. Marvell doesn't need to become the next Nvidia. It doesn't even need to beat every competitor. It simply needs to become an increasingly important supplier to the companies spending hundreds of billions of dollars building the AI infrastructure of the future. And Google may have just given investors another reason to believe that could happen. So here's the question I want you to think about. Are you looking for the next giant AI chip company? Or are you looking for the companies quietly supplying the infrastructure that every AI system needs? Because if it's the second option, Marvell may deserve a much closer look. MRVL could be one of the most fascinating AI infrastructure stocks of 2026. But after its massive run, the real question isn't whether Marvell has an opportunity. The real question is whether the opportunity is still bigger than the expectations already priced into the stock.